So welcome to another Money Club Mondays, where we talk about everything private lending, passive investing, real estate investing, and related to the Private Money Club, which of course the Private Money Club is a money school club where we connect borrowers with lenders, lenders with borrowers, and all kinds of different passive investment opportunities, including private funds and everything surrounding that kind of world. So what we're going to get into today is one of the sources that you can use for funding different deals. So if you're on the lending side of things, or if you're a borrower, today's going to show you another source of funds. And what we're going to talk about is the $1 trillion source, or what we call self-directed IRAs. So I'm going to get into self-directed IRAs today. I did this last week during one of the presentations that Chris and I did, and I thought it went really well. So I wanted to go through it again here on Money Club Mondays with everybody, and then give you some time. If anybody has any questions or wants to get into it a little bit more, we can do that today as well. So I'm going to spend about 30 minutes going through self-directed IRAs, give or take. And then we'll go into question and answer and make sure that everybody's on the same page and you guys are taking advantage of this $1 trillion source. So if anybody has any questions while I'm going, I do have the chat box and the Q&A box pulled up. So feel free to chat in the questions or put the Q&A in there and we can rock and roll. So I'll ask you guys to respond with me too, just a little bit, just to make sure that everybody is following along and continue to hear me and that everything is looking good. So with that being said, is anybody on here have a self-directed IRA currently, or self-directed solo K? Just put I or yes in the chat box if you do currently have a self-directed retirement account. All right, I. Perfect. All right, so I'm going to get into some of the details today for those of you that have them on how to use them. So hopefully you still get value out of this. And again, if you have any questions whatsoever, pop those in and we'll cover those today as well. And if you don't have a self-directed IRA, if you're unfamiliar with those, then you'll be able to learn today some of the advantages. And if you're a borrower, how you can start showing people, in your network. So friends, family, people in your network, the power of self-directed retirement investing to open up a whole new world of funding for your deals. And again, you can go out there and you can talk to friends, you can talk to people if you're looking to borrow, and teach them about private lending, teach them how they can get, lend you their money on deals and how it's protected through the real estate, through the trust deed that's in place, the promissory note, the terms of that contract, and using that home as collateral. So it's a great way to show other people how they can invest, make money off of what you're doing in real estate. Or if you want, a built-in source for those kinds of funds ready for you, the Private Money Club, we have tons and tons of members in there right now that have money ready to invest and that are looking for deals to invest in, whether that's a one-off flip, whether that's a long-term hold, whether that's a partnership type deal, or whether that's a private fund like we do with Safari or some of the stuff that Jack Petrick does. Just to name a couple, that kind of thing. So that's what the Private Money Club's all about. So let's go ahead and dive into this. So like I said, the $1 trillion source is what we call, here we go, the self-directed IRA. So what are self-directed IRAs? So self-directed is not a legal term. Self-directed means that you, not your financial advisor, decides the type of investments you're investing in. So you're in charge of your investment portfolio. And again, everything we teach through the money school, through money multipliers, all about solving your money problem and taking back control of your money. Self-directed investing is one of the best ways to do that, especially when it comes to your retirement funds. So self-directed versus non-self-directed, what we're talking about here, an IRA is an IRA. It doesn't matter if it's self-directed, if it's at Fidelity or Morgan Stanley or whatever the case might be. So again, self-directed just means what you're allowed to invest in. It's not a legal term. It's just descriptive, meaning the IRS is going to look at your retirement, your IRA at Fidelity or your 401k at your job. The IRS is going to look at it the exact same way that they look at a self-directed IRA at Horizon Trust or a solo K at Equity Trust or one of these other self-directed custodians that are out there. The IRS looks at it all legally the exact same. It's just a matter of what can you invest in. So you can have traditional IRA that's self-directed. You can have a Roth IRA that's self-directed. You can have self-directed 401ks or solo Ks, as often with people that like you and I that we work with real estate investors. Solo Ks are typically the most popular for that. You can also have health savings accounts. You can have SEPs, which are simplified employee pension plans. You can have simple IRAs. So any type of retirement account that you can have out there can also be self-directed. All right. So again, when we talk about traditional versus Roth IRAs, so I want to get into that first. So you got to ask yourself, do you want to pay the taxes? Do you want tax-free income for the rest of your life? Or do you want a tax deduction today? Do you want to pay the taxes on a seed or on the crop? So let me just talk about that real briefly. So a traditional IRA or a traditional solo K 401k, what that means is the money is going into that retirement account pre-tax, meaning when your employee pays you, as an example, when you earn a paycheck, typically taxes are taken out ahead of time. However, if you're investing into a 401k, the money from your income is going to be put into that 401k before that money is ever taxed right now. So it's pre-tax money going in. And there can be an advantage to that. If, for instance, you are at a tax bracket, because the more money the way taxes typically work is the more money that you make, the percentage in taxes that you pay, that's your tax bracket. The more you make, typically the higher that's going to be. So if you're able to take money, let's say you make $100,000 and this isn't real, I'm just giving an example. And one of the tax brackets is $90,000. Okay. So below $90,000, maybe you pay 25%. Above $90,000, let's say you pay 30%. Again, these are not real numbers. I'm just giving an example. So let's say that you have $100,000 in income. So now you're in that above $90,000 range. So you're paying 30% in taxes. But what if you could put $1,000 a month or $12,000 a year into your 401k? Well, what that would do is that would take your $100,000 income and that would lower your taxable income to $88,000. So 100,000, you're putting in 1,000 a month or 12,000 a year, takes it from 100 to 88,000. So now your income, taxable income, is 88,000. And that tax bracket is 90,000. So above that, you would have been paying 30% taxes. By getting below that tax bracket, you're now at the lower tax bracket percentage, which is 25% in this example. So now you're only paying 25% on that 88,000 instead of 30% on the 100,000. So I hope that makes sense to everybody. If it doesn't, just write in there that you have a question about it or something like that. And of course, the timing right on cue. My yard guys are out here working on my yard, but just ignore that if you hear the lawnmower or the weed eater going by or my dog barking at them. All right. But the joys of working from home. Right. So anyways, so that's what so that's one of the advantages of being able to put money in pre-tax. And then also once the money gets in there, it then grows within your retirement account, tax deferred. Okay. So this is the other advantage that we're told, because in our earning years, meaning when we're working in our job, we have the highest salary in our life, because at our job, as we go through life, we're going to get more and more promotions. We're going to make more and more money. So you're going to be at higher and higher tax brackets right now. So why not get the money in there into the retirement account where you're not paying taxes on it right now? And then when you retire, you're no longer working. So you don't have that high tax bracket of all that earned income coming in. So you're not in that high. So in retirement, you're going to be a lower tax bracket because you don't have as much earned income coming in. So you're in a lower tax bracket. So we're going to put the money in now. It's tax deferred. And then whenever you pull the money out later in retirement, you won't have as much earned income. So you'll be in a lower tax bracket. So at that time, you will then pay taxes on it when it comes out. However, you're going to pay a lower tax amount because you're going to be in a lower tax bracket later on in life during retirement. I know that's a mouthful, but that's what traditional retirement accounts, traditional 401ks, traditional IRAs, that's kind of like the thought process on what the benefit of them is. And then all that growth within that traditional retirement account or 401k over that amount of time, again, it's all tax deferred. So you pay taxes on it later on. Okay. Now, there's a couple issues with that. First off, obviously, a glaring challenge or issue with that is, what do taxes do historically speaking? And what are taxes doing right now in life, in the real world? they're going up, right? There's all kinds of tax proposals, and we're not going to get into the, it's only for people that earn over 400,000 or 250,000 or whatever it is, highest tax. Anytime the taxes are raised on corporations, companies, etc., it's going to trickle down. It's going to go down to the consumer. You're going to end up paying more for goods. You're going to end up paying more in tax. It all flows together. So anytime taxes go up, typically speaking, we're going to, in one way or shape, fashion, form, pay more. Inflation is one of those hidden taxes. You're paying more because inflation goes up, so the cost of everything you buy is more. So if everything you're buying is more, essentially that's a tax. That's not really a tax. So you're going to be paying more taxes, right? So I think everybody agrees with that. So if we're deferring paying taxes now through traditional IRAs and 401ks until later on in life, 20, 30 years down the road, 40 years down the road, if you're younger, what's the advantage if taxes are constantly going up, right? So that kind of defeats that purpose. And then also, we're then giving up control of our money, because if we just stick it in that 401k, or if you have a financial advisor, you're no longer in control. You're investing in mutual funds, you're investing in stocks, you're investing in things that are completely out of your control. You don't control if Tesla decides to buy $1 billion in Bitcoin and then Bitcoin crashes and their books fall, or if one of their cars that comes out ends up, starting a bunch of fires and then they can't sell them and have to recall them. And, I'm not trying to pick on Tesla. I love Elon Musk actually, but there's a lot of things that can happen that you have no control in. So you investing in any kind of company, it could be any company out there, you just have no control over it. So you're giving up control. And then if you say, all right, well, I want to go ahead and take that money out of my 401k because I want to go do something else with it outside of my retirement account. Well, if you do that before you're 59 and a half years old, not only do you pay taxes on it, but you also pay a 10% penalty. So you're giving up complete control. So there's a bunch of things. All right. So that's what a traditional retirement account is. The alternative to that is they came up with this, I want to say maybe 25, 30 years ago. So what they did is they came up with what's called a Roth retirement account. So you can have a Roth IRA, you can have a Roth Solo K, a Roth 401k. So you can have all these different types of Roth retirement accounts. So what a Roth retirement account is the money that goes into the retirement account. You pay taxes on it first. So I pay taxes. So I get my $100,000 paycheck, I pay taxes on that, but I take a portion of it and I stick it into a retirement account. Okay. Now with a Roth IRA or traditional IRA, you're limited to like 6,500, give or take, annually. With a 401k or a solo K, you're limited to like 50 to 60,000 in contributions annually. But you take a portion of that money with a Roth account, you pay taxes on it now, and you stick it in that retirement account. Once it's in there, the beautiful thing about a Roth is all that money within that retirement account is now in a tax-free vehicle. So you put money in there, it's now going to grow tax-free for the rest of your life until retirement age, when you start pulling it out, and you're never going to pay taxes on any of that growth ever again. So taxes could go up to 80%, but it doesn't matter because we've already paid taxes today on that money. So it doesn't matter what happens with taxes in the future. We've already paid the taxes, and all the growth within that retirement account is now tax-free money. And there's a bunch of famous accounts of successful people using Roth IRAs. When Mitt Romney was running for president a few years back, he became under some scrutiny because he had retirement accounts that had millions of dollars in them. And people were like, well, how does if you can only contribute $6,000 a year into a Roth IRA, how does he have millions of dollars within this Roth? And it's real simple. He took I think he did a conversion of originally, which you can convert a traditional to a Roth to kickstart the thing to have a larger lump sum in there, pay the taxes again on it now. Taxes are going up. So pay the taxes now, get it into this tax-free vehicle, and then make smart investments. So what Mitt Romney did is he went out there and he started investing in business startups. Now, how he got the knowledge and what to invest in, again, we're not going to get into politics here or insider trading or anything like that, but he made smart investments. However he made them, that's up to him. So, but he was able to grow the money within that Roth to millions of dollars, and he now has that money in a retirement account that he'll never pay a dime of taxes on ever in his life. So if you took, just as an example, $100,000 into a Roth, and through smart investing, through business startups, through crypto, through real estate, whatever it might be, let's say you hit a couple home runs and that $100,000 grows to $1 million. you will never pay a dime of taxes on $900,000 of that money. So you just created $900,000 in tax-free income. And I'll show you the power of tax-free income in just a second. It's amazing when you're not paying taxes, how much more wealth grows. And those of you that have been on our Money School preview events or been to our Money School 3-day essentials training weekend, we talk about the 3 enemies that kill us. And one of those, that kill wealth. And one of those 3 enemies is taxes. So these are the kinds of strategies when it comes to building wealth that are very, very, very important to implement into your overall plan. Okay. So that's the difference in the Roth and the traditional retirement accounts. Again, it could be an IRA, it can be a solo K, a SEP, a simple, an HSA, a 403B, all these different types of accounts out there. They can be a traditional, they can be a Roth, they can be a Fidelity in your normal type of investment stocks, or it can be self-directed where you have complete control over it. Now, here's a pretty shocking thing right here. When we look at self-directed retirement accounts, there are, it's actually over 80 million IRAs in this country. I think we're pushing 90 million now. This stat is a few years old, but only 4%, less than 4% of those retirement accounts are self-directed. And of those over 80 million retirement accounts, there's literally hundreds of billions, if not trillions. No, there's trillions. I know there's trillions. There's trillions of dollars in retirement accounts in this country out there right now. And less than 4% of that is self-directed. So why this is such, first off, it's not really surprising. Again, if you guys have been following us, or if you're new, you're going to hear this over and over. We always talk about the 5%. Anytime we do trainings, it's typically about 5% of the people that register actually show up for the whole thing. If you look at the IRS, they tell us that if you take 100 people at retirement age, according to the Social Security Administration, only 5 of those people are going to be able to retire the way that they want to and the lifestyle that they want to. 1 of the 100 will be wealthy, 4 will be doing good, and the other 95 are just either having to go back to work or are dead broke and have no chance of being able to retire. So only 5%. 5% of the people control 90-some% of the wealth that's out there. I mean, you're going to hear this stuff. So the fact that less than 4% of retirement accounts are self-directed is not really that surprising. But what it is, it's a lot of opportunity. Because again, if you're a borrower and you need money for real estate deals, if you need money to go out there and fund a new business idea that you have, if you have a startup or something and you're looking to get that funded, if you need money for basically any type of investment, self-directed IRAs, retirement accounts are an unbelievable source for you to get that funding. You just have to learn how they work so you can go out there and you can tell your friends, family, and your network about them so you can teach them how to take their money and get it safely out of the stock market while we're at all-time highs right now in the stock market. Get it out of there. Get the profit off the table, okay? Get the money out of there, but you don't want it sitting in a savings account. What is money doing sitting in a savings account? Nothing, right? It's growing at 0.005% or 0.1%. Or somebody actually told me the other day they just got a new offer for a savings account right at 1% annual return, which is unbelievably good. But think about it, 1%. What is inflation doing right now? Like, you're losing a lot of money if you have your money sitting. So what do you do with it? Well, this is a great alternative, okay? Putting it into a self-directed account instead of cash and getting it out there working for you. So there's a ton of opportunity. And again, if you have money in retirement accounts, especially if you're approaching retirement age, you need to protect that, because if we have a correction in the stock market, and if it's as heavy as I think it's going to be, if we see a 50% or more downturn, you're going to lose a lot of wealth. And if you're at retirement age and you're planning on using that for income, or you're planning on using that money for retirement, and then all of a sudden half of it's gone, what are you going to do? So we need to start looking at ways to protect that. And this is an excellent way to start looking at protecting some of that money. So let's get that money moved over. So let me show you what we're talking about. So when we talk about building wealth, we do talk about creating multiple streams of income, diversifying, creating wealth in multiple ways. And self-directed investing, self-directed IRA, self-directed solo Ks, you can buy any and all of this stuff within those retirement accounts. So you're not just limited to stocks, mutual funds, bonds, and traditional investments like a financial advisor or somebody at Fidelity or Morgan Stanley or Charles Schwab or something like that is going to tell you about or offer you. Now, Fidelity got a little tricky a couple of years ago, and they said, hey, we now give a self-directed Fidelity retirement account, but it's not really. Because if you call them and say, hey, I'm going to buy this house across the street is a rental property, or, hey, I'm going to take my money and lend it to a friend of mine for a real estate deal or for a new business, or, hey, I'm going to go out there and buy a cow. Yes, a literal cow at a farm you can buy in a true self-directed retirement account. But if you tell this to your advisor, or if you call the support line at Fidelity and tell them this on your quote unquote Fidelity self-directed account, they're going to laugh at you because they have no idea what you're talking about. They're going to think you're joking if you tell them you want to buy a cow, because it's not a true self-directed. What they're saying is they're going to let you self-direct the money into whatever stocks you choose. They're going to let you self-direct the money into whatever mutual funds or lifestyle funds, sometimes they call them, that they're gonna let you pick from, right? Like you're picking it, so you're self-directing it. No. A true self-directed account allows you to invest in almost anything. Now, there are some restrictions to it. So when you're starting out, just make sure you read those. Things like collectibles, for instance, like you can't buy baseball cards. That's considered a collectible, or old coins. Old coins is popular. Like those are not allowed. And there's certain transactions that are not allowed. Like I can't lend money directly to my dad, for instance. It's, when it comes to like direct family, there's some restrictions there. So there are some restrictions, but for the most part, you can invest in almost anything. So residential real estate, commercial real estate, multifamily, affordable housing, mobile home parks, things like debt. So tax liens, that's actually tax liens are very, very popular. Notes, we do a lot. If you've been to our 3-day trainings with Kevin Shortell, or if you're in the private money club, Kevin Shortell's in there and he has notes available, which are mortgages. So you're buying and selling mortgages just like the banks do. What are we talking about? Become the bank. Let's mimic what the banks do. So they go out there and we'll teach you how to use your retirement account to buy notes. You can buy gold and silver, other precious metals. Like I said, private businesses, startups, private loans, becoming the bank. You can still even buy stocks, options trading, things like that with a self-directed. So you're not limited to not investing in the stock market. You can invest in the stock market still, as well as all this other stuff. Intellectual property. So IP rights. I mean, that's something you might run across an opportunity every now and then. The oil and gas industry, there's some great opportunities in there. Although a lot of times they have their own advantages, which we won't get into right now. And then crypto is one of the latest. Obviously in the last year or two has become very, very popular. And to me, that makes a lot of sense because, cryptos are so volatile, and Bitcoin especially. Everybody says, Bitcoin is one of those things that you need to buy it and you just can't watch it all the time. You need to buy it and just, kind of forget about it, or stick it in one of those hard wallets and forget about it. But if you're going to do that, why not do it within a tax-free environment? So let's say that crypto does go to $1 million. Let's say that Bitcoin does go to $1 million a coin. Well, why not buy that Bitcoin today in a Roth IRA? What is it today? 37,000? Let me see. I keep it right on my watch here. I have one of these Apple watches, so I keep it right here. So it's at 35,000 right now, I believe. So Bitcoin's at 35,700 right now. So why not buy that Bitcoin in your Roth IRA at 35,000 and let it sit there? Hey, if the thing shoots to $1 million in the next 5 years, guess what? You'll never pay taxes on $965,000 of that growth. How many of you would like to never pay taxes on $965,000 worth of profits? So why not buy that Bitcoin in a retirement account and forget about it? You can't touch that money until you're 59 and a half years old anyways. So stick it in there. But anyways, so that's one of my favorite uses of it right now, at least. So the point is you can buy almost anything within a self-directed retirement account. So the process for this is pretty simple. And Maureen said, love doing my tax liens, guaranteed 12% a year in New York. Yeah, absolutely, Maureen. Tax liens are great. I used to buy them a lot myself, probably 10 years ago, maybe 8 to 10 years ago. It's been a while because my attention's kind of gone other places, but they really are a great investment. Different. I could actually do a training on tax liens one day. Maybe I'll do that on a Money Club. Would anybody like me to do a training on tax liens during one of the upcoming Money Club Mondays? Just write yes in the chat box if you'd like me to do a tax lien training sometime. Okay, cool. All right, I'm getting a bunch of yeses. All right, I'll do a trading on tax liens. Tax liens and deeds. So states are a little bit different. Every state is different when it comes to, is it a tax lien, is it a tax deed? How long's the redemption period? What's the interest that they offer? How do they work? Are they offered in person, at auction, on the internet? Like, they're all different. So there's a lot to it, but yeah, I could definitely do that. Okay, Maureen said she'll help me. That'll be a lot of fun. All right, Maureen, I'm going to get with you. Let's get together, and I'll have you come on and you can talk about your experience. I'll do some training. I'll have you come on and talk about what you've actually done with it. That'd be a lot of fun. All right, perfect. We'll do that in a couple of weeks. All right. And then Angie said, can you talk a little bit about pros and cons of real estate syndication? Yes, I will do that, Angie. All right, let me just hit it right now. So, so real estate syndication is very similar to a private fund. Typically you have so what a syndication is, in case anybody's wondering, is let's say it's $1 million real estate deal. A lot of times, like, it'll be like a value add, multifamily apartment complex, for instance. So let's say it's a 100-unit apartment complex. Maybe it's, 25 years old and the owner hasn't really kept up with it. So, the units are getting older. It has, all the original toilets in it, or, maybe the lights in the place are, all original, and, the ceiling fan, like all this stuff, maybe carpeting in there, or whatever. It's getting a little older, run down. Maybe the grounds aren't the best. Maybe they need some rehab, some paint, maybe a roof, so it's typically like a deal like that. And what these syndications look for, what private funds look for, this is what Jack Petrick does a lot. And any of you that are in the private money club, if you have not spoken to Jack Petrick yet, I highly recommend it. Jack is very experienced, and Jack loves talking about these types of deals. So he loves to educate as well as, teach you how to invest with him and what he does. So he's a great guy to talk to. So if you haven't, make sure to send me an email and let me connect you with Jack, because you definitely, even if you're not investing with him right now, make sure you chat with him, because he's a great resource for education, and he can send you some different videos and guides. He was on one of our group coaching calls a couple months ago too. I'll put my email in there. If anybody needs anything or has any questions, just send me an email. All right. So, so typically, that's what syndications look for a lot as well. There's all kinds of different real estate syndications. There's commercial properties, like shopping plazas and shopping centers and things like that. There's land development syndications. So there's all kinds of different syndications. But the multifamily, I know, is pretty hot right now. It's affordable housing, which is a great asset class to be in. And there's all kinds of advantages. Told you my dog was coming. So that's the bottom line is, the pros are, it's a great place to be right now. You can pool a bunch of money together to control and buy the asset. A lot of times with the syndication, you have a little bit more input on how it goes. So you can kind of control like what's going to happen, make some of the decisions. Sometimes you can't, you can be more passive on them. So it just depends on it. But it's a great way to get into some of these different projects and some of these larger deals. If you don't have like all the money, or you don't want to go out there and raise the money on your own, somebody else has kind of put that together and you can be part of it all. So they're a lot of good. I'm not sure if you have any more specific questions on it, Angie, but they're really good. And I know you can use your self-directed retirement accounts to fund those syndications as well. All right. So back to the IRA real fast, just to give you an idea of how this works. So right now, let's say you have your money at, the dogs took off running, looking for my dogs. Yeah. Sorry about that, guys. The timing, it's always the timing, right? But so the IRA custodian or the financial institution. So typically you'll have your retirement account, like I said, like a Fidelity or a Schwab or a TD Ameritrade, wherever the case might be. So first step is we need to transfer that money from wherever it is now over to a self-directed custodian. Now there's a bunch of self-directed custodians out there. You can Google self-directed custodian and a bunch will pop up. Some are cheap, some are more expensive. What I always say, what we always say is cost. Cost only matters in the absence of value. So a lot of times you get what you pay for. So I've seen a lot of these kind of discount self-directed custodians, and people, like, things are not done right, especially in real estate. Those of you that are in real estate, like if you have a hot deal that's ready to go, if you're not ready to close on that deal right now, what's going to happen with that deal? It's going to be gone, right? And there's nothing as a real estate investor that's going to piss you off more than if you lose a deal because the money took too long to go to where it needs to go to close that deal. And I've seen it happen before. So little things like that. So, we work with a company, Horizon Trust Company. We had one of our members that had an issue with Horizon last week. Chris and I immediately text and email the owner of the company. And within 30 minutes, he had his entire team on a conference call addressing and fixing the problem that our money school student had. So, they are going through a lot of growth right now as well, and they're doubling their team and stuff. So but they are an excellent company, at least from our experience in the past, because if something does have a problem, they are going to fix it and make it right immediately. The customer service could not be better for that. B, they work primarily with real estate investors. Their owner and CEO and managing partner of the company is a real estate investor first and foremost. So he understands all of this stuff and how it needs to work. And he teaches his team on how to do it all. So they're a great company to work with, Horizon Trust. Also, if you're a money school student, so if you're in the private money club, we do waive the $350 setup fee also through your relationship with us. They waive the $350 setup fee. So you save a few bucks as well. But their annual fees, to keep that self-directed account there, I would say are about average, just to give you an idea. They're not the most expensive. They're not the cheapest, but again, you get what you pay for. So in our experience, the value from what you pay for a self-directed annual account with them is well worth the money. So that's all I'll say about that. Pick whoever you want. But what happens is you take the money from wherever it is now and you do what's called a direct transfer from where it is now over to the self-directed custodian. When you do this direct transfer, there's no tax consequences. Okay. So you're not paying any penalty. You're not paying any taxes. It's just moving the money from one qualified brokerage firm or custodian to another qualified brokerage firm or custodian, just moving it over. Okay. Now, if you move that money over and you do a traditional to Roth conversion, again, you're not going to pay any penalties or anything like that, but you are going to pay those taxes. And whether that's the right move for you or not, that's completely up to your situation. So I can discuss that with you. If you go through Horizon, you do have a dedicated account rep. Her name is Brandy. She's very good at talking that through. Hey, would it make sense to do a traditional to Roth conversion? But if you're younger or if you're looking to do some investing that your money could explode, so startups or really strong real estate investment deals, to me, it makes a lot of sense, again, for all the reasons we talked about earlier, to pay those taxes now, get that out of the way, and get that into a tax-free vehicle. But again, that's on a one-on-one basis, on a personal situation basis. All right. So once the money is over there at Horizon or whatever self-directed custodian that might be, the account is now funded. Okay. So once that account is funded, you're now ready to use it. So what would happen is now you identify what your investment's going to be. Let's just say it's a private loan. This is the private money club, right? So let's say you identified a private loan. Let's just use Safari as an example. So you said, hey, I want to invest in mobile home parks with Chris Naugle and Chris Rude. So I'm going to invest in the Safari fund. The Safari fund pays anywhere from 7 to 12%, depending on if you lock it up for 1 to 3 years. Okay. Let's just say you decide to do it for 3 years at 12%. So you identify that investment. What you do is you fill out the contract, you fill out the paperwork for that Safari fund investment, and you also fill out what's called a direction to invest form. Okay, you can print that off right off of Horizon's website. You can request it from your agent. However you do it, you take it, you fill it out. It's real simple. It's like a one-page document. You sign it. You submit the direction to invest form along with the accompanying paperwork. In this case, the contract, the promissory note, and everything for the Safari loan. You submit that to Horizon Trust. They review it all to make sure that it's right. Okay. Because if you do a wrong transaction, it'll mess up your whole account. So they're going to verify to make sure everything looks good on there. They're going to submit it, and they're going to then transfer the money from your retirement account, whether it's a solo K, whether it's an IRA, whatever it is. They're going to move that money from there over to the Safari fund, and your money's now in the Safari fund growing at 12% annually. As the interest is paid on that, interest on this particular Safari fund is paid monthly. So what's going to happen is each month, a check is going to get sent back to your retirement account. and it's going to go back into your self-directed IRA or Roth Solo K or whatever it is. And it's going to sit in there and it's going to grow either tax deferred or tax free. So that money's going to go back in there. And at the end of the 3 years, your principal investment, however much that was returned back to that self-directed account. And then it's ready to be used over and over again. So that's how that's going to work. And whether it's a rental property, whether it's crypto, whatever the case might be, that's exactly the same process. Now, I wanted to mention one other thing. There is another type of self-directed retirement account called checkbook control. And checkbook control gives you ultimate control, meaning instead of having to complete this direction to invest form, submit it to the custodian and have them initiate that money transfer, you're going to do it yourself directly from your retirement bank account. Now, we can set this up for you. Don't worry. And if you want a self-directed checkbook control account, just let me know and I'll connect you. We got a really good deal worked out with a partner that creates these through Horizon Trust as well. Yeah, and EQRP is very, very similar. Jade, absolutely. Checkbook control is just the way and the setup and who manages it and how the administration is done through a solo K checkbook control account is a little bit different than an EQRP, but very, very similar concept. So with the checkbook control, the only difference is, again, instead of filling out that direction to invest, you're simply writing the check yourself. So if I was doing a private loan to Jade, for example, I would just do the paperwork, and then I would just take out my checkbook. I would write whatever the loan amount, let's say it's $100,000, write the loan to, Jade's company for $100,000 or to the escrow company or wherever the money's going. And then I would just do it myself, or I would do a direct wire transfer from that checkbook control bank account directly to wherever it needs to go, the escrow company, attorney, whoever it might be. So a checkbook control just lets you skip using the custodian as the middleman, and you can do the direct investments. Now, you just want to be careful with that, because if you were to accidentally write a check like to the grocery store or something, or just, you write a check to something that's not allowed by the IRS in a retirement account, it can disqualify your entire retirement account, meaning it can make the entire thing. You might have to pay penalties and taxes on the entire amount within your retirement account by doing one small mistake. So just be very careful with a checkbook control account. And that's why I say, if you're new to self-directing, I always prefer you don't do that at first. Go through the middleman a couple times, let them look over everything for you, make sure you're doing things right, and then maybe open up the checkbook control account. But it's completely up to you and, how comfortable you are with that kind of thing. All right. So a few options for using self-directed IRAs. So number one, of course, you're buying a home for $100,000. I'm using round numbers here, just so you guys know. Let's say you want to buy a home for $100,000. You got $100,000 in your IRA, plain and simple. Your IRA buys that home, 100% used to buy it, 100% of the profits go back into the IRA. Nice and clean and easy to do. Number two, you can co-buy with your non-qualified funds in your IRA. So what that means is, let's say I'm buying that $100,000 house, but I only have $50,000 in my retirement account, and I have $50,000 sitting over in a business account or in a savings account. Okay. Somewhere that's what's called non-qualified funds, or a money multiplier policy. This would be a great example. Okay. How to use your self-directed with a money multiplier policy. Because again, your self-directed IRA or solo K is what's called qualified funds. Your checking account, your savings account, your money multiplier policy, that's all what's called non-qualified funds. Okay. It's just a matter of what the IRS looks at it. So what we can do is we can take $50,000 from our IRA. We can take $50,000 from our money multiplier policy, and we can buy that $100,000 together. Now, what would happen in that case, since it was 50-50, 50% of any and all profits, whether that's rent, whether that's profit once the deal sells, whatever the case is, 50% of all profits will go back to the IRA, and 50% of all the other profits are going to go back to the non-qualified checking account or wherever it came from, meaning no taxes or tax deferred on the retirement, 50% retirement. And then you will have to pay taxes, or deal with the taxes, I should say, on the other 50% of profit over here. But it has to be equal. If it was 30% and 70% going in, 30% and 70% needs to go back out. It could be 90% and 10%. It doesn't matter what the percentages are going in, as long as those are exactly the same coming out. And remember, if you do that with real estate, and that's why we prefer lending on real estate deals as to actually buying homes with a self-directed IRA, because it's very easy to make a mistake. Because if you were to buy this 50-50 as an example, well, if it's a rental property, let's just say you decide that you're going to, as the landlord, as the owner of the home, you're going to pay for the maintenance on the yard. So you're going to pay for the mowing and everything, right? Well, you don't think about it. Let's say it's $100 a month for yard service. Well, that doesn't seem like a lot of money. So maybe you're like, well, I'll just go ahead and write a check to the lawn company from my business account or from my checking account because I don't need to do that with my IRA, right? Well, that's what will get you in trouble. Because if you use any or all of your IRA to purchase that home, any or all of that percentage that was used to purchase has to be used for any and all expenses as well. So even something as silly as, let's say you had to get a new front doorknob that costs $50. Well, you need to use your IRA money or a portion of your IRA money to buy that $50 doorknob. So that's why it can be a little iffy when using self-directed IRAs to buy an actual home. So not to say that it can, just be very, very careful with it, okay? And just understand all and any expenses, everything needs to be done the exact same proportional way. So keep good records, keep good spreadsheets, make sure everything stays proportional, and you keep everything because you might need to prove it down the road that you are doing things the right way to protect your retirement account. So again, it might be good just to do loans. I know one strategy that a lot of people will do, like for instance, Chris Naugle and myself. Like if I wanted to buy a rental house right now and Chris wanted to buy a rental house right now, and let's just say they were both $100,000 each. Well, instead of me using my self-directed account to buy the rental property, what I would do is I would do a private loan to Chris Naugle to buy his. He would do a private loan to me so I could buy mine. So that way the retirement accounts are now owning, and the investment was the loan and not the house. And that way the home itself is outside of the IRA. So little things like that. Yeah, great for funds and notes. Yeah, absolutely, Jane. Okay, cool. All right. And then there's one other thing that I love about self-directed accounts. And this is what I love about real estate in general, is when I first learned about real estate in general, is one of the cool things about real estate is leverage. Meaning I could go out there and I could put $20,000 down and I could get a loan for $80,000, and I could go and I could buy a $100,000 home with 20,000 of my own dollars all day, every day. That's called leverage, using a smaller amount to obtain something with a much larger value. Okay, we're leveraging our down payment to purchase that home, right? So you can do that with self-directed retirement accounts as well. What it is it's called a non-recourse loan. So what this means is if I wanted to buy a $100,000 home, but I only have $20,000 in my retirement account, what I can do is I can go to a bank, and there's a few nationwide ones, as well as there's a lot of local people that do this, but and I could go out there and I could secure a non-recourse loan. And what that means is I would use the $20,000 from my retirement account as the down payment for this home, for this non-recourse loan. And the bank would finance the other $80,000. So I could go ahead and purchase that home within my self-directed IRA using only $20,000 instead of the whole $100,000 of home value. Now, the difference in a non-recourse loan versus a typical mortgage or loan that you get from the bank is what the bank is what's the word? What the bank can do, the recourse. Yeah, the recourse, it's right in the word, right? So the recourse that the bank has if you were to default on that loan, meaning if I was to go to a bank right now and get a mortgage for $100,000 and I don't pay for that, mortgage, I walk away from it. Well, that bank can take the home, they can foreclose on the home, they can sell that off. But if that doesn't cover the $100,000 loan that they gave me, let's say they can only sell the house for $50,000, they can come after me and my assets and me personally for the remaining balance for that other $50,000 that I still owe them. So they can sell the house. But with a non-recourse, because a retirement account is protected from debtors and bankruptcy and things like that, they can't come after it. So what happens is they can't come after you personally at all either. So it's a non-recourse loan. So if I was to default on that loan, they can foreclose and take the home away, but that's all they have. So they have to hope so a lot of times it'll be a larger down payment for a non-recourse loan, and the restrictions might be a little bit tighter. Like you might need 25, 30%, but that's just because the bank doesn't have any other means to get back their money. If something was to go wrong, they can only take back that home, try and sell it off. So that's what a non-recourse versus a typical loan. Those are the only differences. But the beautiful thing is that these banks are willing to do non-recourse loans, so we can use our self-directed retirement accounts to leverage our money and buy and control, much higher amounts than what we start with. So that's a wonderful thing. All right. And like we talked about, of course, you can loan funds directly to other investors. This is an example earlier. I was telling you, like when you don't, when you're taking advantage of things like tax-free wealth growth, when you're growing your money, growing your wealth tax-free. I mean, take a look at this. If you take $45,000 that's being taxed, or $45,000 in a Roth account that will never be taxed. Let's just say you're growing your money annually at 17%, and you do that every year over the next 20 years. And let's just say over here, you're paying 30% in taxes annually, which is pretty conservative these days. And over here in the Roth, you're paying 0 because, again, this is tax-free growth. Well, you're going to have $426,000 versus over $1 million. So you're almost, you're almost tripling, between doubling and tripling your money over the exact same amount of time, with everything else being the same except for the taxes. So it's just amazing how much your money can grow when it's in these tax-free vehicles like this. I mean, look at the money multiplier policies. The growth within your money multiplier policy is all tax-free growth for the rest of your life until the day you die. And look how much those things grow when you take advantage of compounding interest, uninterrupted, guaranteed compounding interest, right? Uninterrupted compounding interest coupled with tax-free growth. Look how much your money is growing cash on cash annually 20 years from now, 30 years from now. It's unbelievable. It's just very, very powerful. So somebody asks, can you give us a couple of banks that would do non-recourse loans? Yeah, absolutely. I'm not sure who this is. It says anonymous, but if you send me an email, Snaggy, S-Nagy, I'll put it in the chat box, at chrisnaugle.com, I can definitely send you a few. I'll send you a few banks that do the non-recourse loans, I believe in all 50 states. All right. So I know we're going long here right now. Does anybody have any other questions? I got one more little case study I'll share with you guys as we're wrapping up here today, but I wanted to answer any questions since I'm going pretty long right now. Does anybody have any questions? If you do, put them in now. If not, I'll go ahead and finish up this last case study and we'll wrap up for the day since we're going long. But if anybody wants to talk to me on a one-on-one basis, or if you want an introduction to Horizon Trust and an introduction to Brandy, so you guys can set up a call and talk more about your situation, just send me that email and I will definitely set up a call and make that introduction for you. Jade said, do you still have RMDs, which are required minimum distributions, on QRPs, which are qualified retirement pensions? Yeah, I believe you do, Jade. I'm 95% sure there are. I just have to do some research, and they are doing, I would just have to double check that for you, Jade. Sorry. But they are making some changes right now to, or at least there's some proposals out there. I don't know if they passed yet, but to the retirement age, to the required minimum distribution, age and amounts. And there's some different little things that are happening right now. One of the things about IRAs is the contribution limits. Those typically change each year too. They were 5,500 annually a few years back. Now I think they're 6,500, and you can do an extra 500 to 1,000 annually if you're over 50 years old. They call it a catch-up contribution, like you're trying to catch up. So they let you put a little bit more in there. With a solo K or a 401k, they allow you to put depending on your income and how your business does, they let you put like up to 55 to 65,000. It might be like 66 or something now, but so those are always changing. But yeah, it's just one of those things we would just have to double check. So I don't see any other questions coming in. So hopefully everybody's following this. But again, just email if you need anything else. And I'm going to wrap up with this last little case study right here, because this kind of ties in everything that we do with self-directed IRAs, with the money multiplier, and with the private money club. You know, the private money club is all about these private loans, these private investments, these private funds, these ways of lending your money, protecting it, and letting it grow consistently for you. And you couple that with tax-free growth. Again, the power of it, the power of the wealth creation within there is really unbelievable. So this is a cool case study on showing you how to create consistent, predictable income for the rest of your life. And hopefully you guys like the sound of that: consistent, predictable income for the rest of your life, because I absolutely love it. So here we go. So this is Charles and Mary Jones. Charles and Mary Jones, we call them the Bank of C&M Jones. And this was a real case study. This was done by clients of Horizon Trust. Their CEO, this was actually some of his students a few years back. And he's the one who originally introduced me and showed me this. So we love using it just because it's a great little example. So Charles and Mary Jones out of Idaho, they owned a farm out there. At the time, 55 and 53 years old. They had 10 years from retirement. They had $350,000 in their retirement accounts, which if you're 10 years from retirement and you have $350,000 or less in your retirement accounts, it's time to do something different and get those things going, because you're running out of time and we need to get that money growing and compounding for you immediately. Or you're going to have to work longer. You're going to have to work harder. And that's not what this is about. This is about working smarter, not harder, and changing one or two things that will allow you to change everything. Okay. So inexperienced at managing investments, and they did not want an active role, meaning they didn't want to actively go out there and do flips. They didn't want to actively go out there and run a wholesale business. They didn't want to manage projects. They just wanted a way to grow their wealth. So what we did is we showed them how to become the bank. So they went out, they created these 6 to 18 month mortgages, or what we call trustees. So these is, if you're in the private money club and you're borrowing or you're lending for flips, for instance, this is exactly what you're going to be doing. You're going to create these little mortgages, trustees, promissory notes. And what these on these contracts, there's 4 very important parts of these contracts. So number 1 is the loan amount. Plain and simple. How much are you lending for that deal? Okay. Let's say the investor needs $150,000. You're willing to lend $150,000. That's the loan amount. Number 2, what are the terms? Meaning how and when is that money going to be paid back? So I lend you $150,000. Are you going to pay me interest only on a monthly basis? Are you going to pay me interest and principal amortized on a monthly basis? Or is it just simple interest and principal on a monthly basis? Or is it interest and everything is all deferred until you get all the money back at one time at the end of the term, at the end of that term? Maybe it's 6 months, maybe it's 12 months. Is there a balloon payment at the end? Is there a possible extension if needed at the end? So what are the terms? How long? And then number 3, what's the interest rate that you're going to charge for your money? So if I'm going to lend you $150,000 with interest paid monthly with the principal due in 12 months, how much am I going to charge you? Well, let's say you're a brand new investor. I've never worked with you before. You don't have a lot of experience. Well, to me as a lender, that's a little bit more risky than if I was lending my money to Chris Rude, for example. If I lend my money to Chris Rude, he's done hundreds, if not thousands of flips. He's got a team in place. He does several properties at a time every single month. And I know if I give him my money, I'm going to get it back very quickly and there's not going to be any problems. And if there is a problem, he knows exactly how to handle it. So I'm going to give my money to somebody like Chris Rude for a lot cheaper, maybe 9 or 10%, as opposed to somebody that's brand new that maybe I'll charge 12 or 15%. And guess what else? If I'm going to lend it at 12% to that person that's brand new, but I'm still not comfortable, maybe I'm going to charge them 2 or 3 points. So what are points? Points are simply a percentage point on the total loan amount. So if I lend $100,000 and I charge 2 points, that's $2,000 right off the top that I'm charging to lend my money. Okay. So that's what points are. So the interest rate and points, how much we're going to charge for that money. Again, this is all a negotiation. It all depends on the person's experience, what the deal is, how long, the terms of that deal, how much the amount is. All of that stuff goes into not only the negotiation, and then it also goes into the contract, the promissory note, and ultimately this trust deed. And then what else needs to be on there? Once I know how much I'm lending, for how long I'm lending, and how much I'm going to charge, well, if something was to go wrong on this deal, what is protecting my money? And that's what the collateral is. So in real estate, it's typically going to be the home. Okay. So that home, if something was going to go wrong, all I do is I take control of that property. I either have foreclose on it, or I have something in the contract that gives me now ownership of it, where I now control that property. And there's some other things, obviously, that need to be on there. You need to have insurance on the deal. We then need to take this trustee. We need to go file it at the courthouse to make it all official. There's other things that need to be done when it comes to private lending, but just showing you these trust deeds, those are the 4 most important parts that need to be on that trust deed each and every single time. Okay. Loan amount, terms, interest rate, and collateral. What is protecting your money? So in this case, Charles and Mary, they decided that they were going to go ahead and take their current retirement accounts and continue to contribute to those retirement accounts $6,500 each for the next 10 years as well, annually. So they were going to continue to contribute $13,000 annually into their accounts for 10 years. And then they were going to take their money and start loaning it out at 9%. Now, they were in Idaho. They were lending to friends and family. So they were willing to lend at lower interest rates. Again, very common these days, 10, 12 plus percent, plus points, things like that, depending on the deal. But they were decided to do it at 9%, so very conservative. And what they were able to do by following this simple model right here, starting with 350, continuing to contribute for 10 years and growing their money at 9%, through private lending trust deeds, they were able to grow that 350 over 10 years to just over $1 million. So they now are at retirement age, and they now have just over $1 million sitting in their retirement account. So they're doing a little bit better, right? However, what they decided to do from doing private lending now for 10 years is they said, okay, well, we're in retirement, but these private loans are very easy. So why stop? There's no reason. We're going to continue doing private loans. We're going to continue lending. The people we're lending to want to continue doing flips. They want to continue doing deals. They need our money. Things are going very smooth. It's very easy. It takes us no time. So let's continue doing this. So Charles and Mary went out there and they said they took their $1 million and they just continued to lend it out at 9%. And what that did is that created a $92,000 annual income for them coming in each year, or another way to look at it is $7,700 a month coming in each and every single month that they can bank on, that they can count on for the rest of their lives while they keep doing these private loans. And they will never touch that $1 million by doing this. So they created a $92,000 a year salary for themselves, and they never touched their $1 million nest egg. So down the road, if they ever need to break into that $1 million, they have the money sitting there for them. If they, don't ever need it, they can pass it down to kids, grandkids, charities, whatever the case might be. But it gives them options. It gives them that security, and it gives them that freedom to know they have that consistent, predictable income now coming in for the rest of your lives. So I hope you guys like that case study right there of Charles and Mary Jones. I hope you got some value today out of self-directed investing. Again, self-directed, it's not a legal term. It's just a way of who has control of your money. What are you doing with it? That's what the Private Money Club is all about, is controlling your money, taking back control of your money, and knowing how to put it out there working for you in these investments that, in my opinion, are way, way safer, way, way less risky than keeping money blindly in the stock market or mutual funds or the traditional ways of investing out there. And allows us to take back control and create these predictable, passive types of income streams that are going to provide for us and benefit us for the rest of our lives. So I don't see any questions coming on right now. So thank you all for joining me for Private Money Club and Money Club Mondays, and we will see you guys next week. Have a great week. Thanks, guys.